Then the next one I was going to talk about was ARCC, but we'll see if that's something we want to cover.
Yeah, we can get into ARCC to get started. And while I have the mic, Brandon, I see GMAB. It's on the list, sir.
Okay, let me add it to mine as well. Okay, I know a lot of people that are invested in ARCC. It's a business development company, and it's related to Ares, which is an asset manager. So this is an externally managed BDC. But I want to point out their book value. This is something I watch very closely for BDCs is their book value. So in 2021, when I started managing my own investment, they had a book value of $18.95. Then it dropped down 50 cents to $18.41. In 2022, 2023, it went up to $19.25. In 2024, it went up to 19.87. And then their current book value for the trailing 12 months is 19.88. So this is the way I tend to, I hate to use the word time my buys, but I watch this value very closely. I try not to buy if it's extended too much above that price. And I start looking for opportunities when it drops down below its book value, which has to be adjusted by year. So I started buying this one in 2021. I have an average cost of just above 1750, about 1760 or so. And I have this aqua colored line or cyan colored line at the book value. So on my daily charts that I manage all of my holdings with, I always have that line sitting right where the book value is, so I can keep an idea about where either it's extended above or price below. So you can see all of my sell points. I was trimming because it was getting a little bit extended. So I owned 1,500 shares, and I've trimmed about 2/3 of those at this point, which has basically returned all of the capital back to me. So I'm in this with no invested capital. It is getting down below its book value again, which it hasn't done since the April tariff announcements. So that this wasn't a surprise here, and you almost have to kind of exclude that, but it would have been a good opportunity to buy. This one pays a dividend of 9.67%. So I'm an income investor, and this is a really nice yield, and my yield's a lot higher than this. So anyway, now that it's getting down below the book value, I'm going to start watching this to see when a good buying opportunity might come back in. With the reduced rates, interest rates, BDCs tend to be hurt a little bit with those. So you have to take that into consideration when you're buying these.
Is that because they will when they do a deal, the implicit rate on that deal, the interest that they expect to make is going to go down substantially?
Yep.
Okay.
So anyway, now that they're getting below that book value, it starts to become enticing. So let me just go to like 3 months. No, I'll go a little bit more, maybe year to date. Just keep an eye on this RSI. So nope, I didn't want to do that. I want to do this. This RSI is currently sitting at 26. Very oversold. So when that starts getting more positive, then we probably bottomed out, and things will start turning around. And also an eye on this PPO, which has been in a downward configuration since July. Then if I take these off, we can see that the difference in the moving averages is starting to converge. And as soon as we get a bullish crossover, might be a really good time to, if you're an income investor, want to make sure you're getting a good price. This will indicate that you're getting a good price.
Interesting. Okay, so looking at Ares Capital and kind of doing just a fundamental review. So market cap 14 billion. The stock has come down 5.65% on its price. It pays a very nice dividend of 9.67. And over the 5-year, this is done quite well. If you consider, if you're making a high dividend and you add an appreciation of 40%, you're doing okay. When we look at a couple of things, I wanted to look at their actual financial statement and understand, how do these guys make money? So here's their statement of operations, or I like to call it the income statement. So they make money off of their investments, first with interest rates. So if we look at for the 6 months, first 6 months of 2025, they've made $1.47 billion of revenue. Most of that is interest income from investments. So they're making an interest off of an investment. And the logic that, hey, if interest rates are going down, these guys are going to be affected by it, that's completely logical. Then they have some fees around capital structuring fees. Dividend income is the next biggest category. So they're making dividends on investments they're making. So that's how they make money, is mainly on interest. They're making deals, and that's where the income that they're generating. What's their expense? So they are paying interest. They are paying some management fees.
Yeah, they because they're externally managed.
Okay.
By Ares.
So they're quite profitable. That's a pretty good profit margin. And then they have some, sales of businesses and so forth. So overall, they're quite a healthy company. Their earnings per share did go down from last year to this year. First 6 months, it went from 1.28 down to 88. So that is that's a negative trend. Moving back to just taking a look at their fundamentals, let's take a look at their forecast. 8 analysts cover this company, 15% discount. It's expected that their revenue is going to expand for 1 year and then be flat. And their profitability is going to go down a bit over the next couple of years. PE ratio is going to stay low. So this is a really nice income idea if you're looking for income, maybe an older investor. And the things that I think are going to help Ares Capital Corporation is we are in an environment where more deal making can happen. We are in an environment where acquisitions can happen. And if these guys can get involved in maybe financing some of those transactions, it could help them quite a bit. But the negatives are lower interest rates, if lower interest rates are going to reduce the amount of interest, because interest was their biggest revenue, then it's going to affect Ares Capital. So, all right. So that is
let me close out with my trade history just so you can see that, and I can show you that watching that book value on this kind of business is a pretty good thing to do, and make sure you're buying low and trimming if it gets too extended. above that book value. So you can see all of my trades here. I bought as many as 1,860 shares. I held 1,500 shares for quite a while. And then you saw the trimming that I started back at the end of last year. So I'm down to my core holding of only 500 shares. And I'll continue to watch that book value and the charts to determine when I start ratcheting this back up, which may be over some time. But this has provided $11,000 of return for me. I don't have any losses. None of these are losing trades. So watching that book value is pretty valuable. It's been on the total return, it's been 34.1% since my first buy back in 2021. Annualized, that's 15.1%. For my current holdings, my return are 105.4. Annualized is 46.6.
Nicely done. And the thing I'm walking away with, maybe other viewers are realizing it, is how we buy stocks is really important. It's kind of easy to find really good businesses, right? You look at like NVIDIA, man, that's a great business. How we're going to buy NVIDIA makes the big difference between making a lot, maybe not making any money, or even losing money. So how you buy is really important.